It seems just about everywhere someone is trying to sell you a good investment. From gold futures to micro stocks, the pitchman or pitchwoman is out there in abundance. Often it's not apparent until later that the investment was not a good investment, at least not good for you, probably very good for them, but at that point it's too late. They've made their money and you've lost yours. The retirement and pre-retirement community is the most susceptible to this bad behavior. There's a population of this community that feels like they may have missed the boat, or at least got on the boat late and want to catch up. And frankly, because of a lifetime of savings, they have the money to try. Let me start off with a whopping disclaimer. There are some horrible investments, scams in fact, where a small group of people hit it just right. Like a stop clock that's right twice a day, there's a small group of investors, a tiny group of investors that actually do receive the performance that is being touted, and the person selling you these investments will use that information to talk about the returns on the product. But for the vast majority of people, the odds are exceedingly small that they're going to hit it right on these long shots. At least when you buy a lottery ticket, the pitch line is, hey, you never know, and that stops people from investing their life savings in lottery tickets, generally. There are also investments that provide great returns if you're willing to become an expert in the asset class. People spend hundreds or even thousands of hours understanding the market. But for the layperson, the risk is just bad. Maybe even worse than just throwing the dice, because on the other end, you have really educated people who know what to do and what not to do. Think rental real estate here. The right property at the right price can provide wonderful cash flow and tax advantages for the expert, but you need to know what you're doing here. Imagine if you stumbled upon a property that satisfied your basic criteria for investing. The property was in good shape. It had a good price. It was in a good location. It was in an affluent community. In fact, the rent covered the mortgage and then some, provided wonderful cash flow, and the current tenant was one that wanted to stay with the property. There was just one problem. There was an ordinance that was being discussed. It was probably going to go through that would prohibit rental property in the community because it was so affluent. They didn't want renters in that community. Due to the sheer wealth in the community, a few of the residents hired a lawyer, put this in motion, and it's probably going to go through. This is actually happening right now. Now you come along and you note that the rental property is listed for 20% less than it was last year. The broker forgot to tell you about the ordinance, and so you jump on it. So those in the know, take advantage of those not in the know. Then there are those investments that traditionally do well, but from time to time they do badly. You get in at just the wrong time and it takes time to recover your investment. And for some people, they get out at the wrong time. They sell when they should be buying and buy when they should be selling. Think about an S&P 500 index fund. If you had been investing in the S&P 500 index for years, and in March of 2020, because of what's going on, you would have sold at a big loss, you would have crystallized the loss, only to see the market come back 6 months later. Then there are the alternative investments. These look a lot like property because you have to be an expert to invest in them. But unlike property, there are very few experts out there because most of these assets require you to seek out and learn private information, and that's not easy to come by. Think about things like master limited partnerships, tax lien certificates, oil and gas drilling rights. In each of these categories, there are people that are making 7, 8, maybe even 9 figures consistently. You don't know who they are because they don't want to talk about it. In fact, if someone's trying to sell you their system on how to buy and sell rare stamps, you got to ask yourself, why are they selling you the system instead of doing it themselves? The investments we're going to talk about are none of those. They are easy to acquire, the price is easily determined, and there's a big market for it. There are a lot of people buying and selling, and they're talking about it. And because of this, that makes these investments very dangerous because of what I call the Superman syndrome. Someone who has been good at investing historically thinks that they're going to be good at investing in these asset classes as well. And if you have money, you can go out and buy these assets tomorrow. You'll pay the market rate more or less, but they're easily available. All right, let's get into it. Stick around to the end because the fourth one is the most relevant and probably the one that many of you are considering right now. The first one is penny stocks. Penny stocks are companies that are thinly capitalized. You can buy and sell the shares on what's called the pink sheets. Basically, it's a price that's put out once a day, so it doesn't change. and you can acquire a lot of shares in a particular company for not a lot of money. People buy these because if they hit, they're going to hit big, but most of them don't in fact hit big. In fact, most of them go out of business very quickly. The next category is options. Options give the owner the right to buy or sell a stock at a particular price. They are highly leveraged instruments. Options have a time limit, so they can expire worthless, and the price is unpredictable, so the owner can lose all of their money. The next category is futures. Futures look a lot like options, but instead of attaching to a company, they attach to something that's traded on a futures exchange like currency or commodities or metals. Futures trade in contracts, and they're also highly leveraged. A 1 penny move in soybean futures gives a $50 improvement or decline in the value of the contract. So you can see that it would be very easy to make or lose a lot of money very quickly. And a big flashing red light, the vast majority of retail investors, if you want to use that term, in futures lose all of their money. Something like 70 to 80%. It is that dramatic. And the final one, the one that you'll hear of a lot more than the first three combined, is cryptocurrency. There are certain trigger words that cause people to lose all sense of perspective. These words are things like the richest 1% and other people's money. In the early 2000s, the trigger word was .com, and we all know how that ended. These words have a tendency to get people to open their wallet and invest in things that they should not invest in. Cryptocurrency is the .com of today. When people hear the term cryptocurrency, they have visions of making millions and millions of dollars, despite the fact that most people don't make millions and millions of dollars in cryptocurrency. They know the story of how Bitcoin went from $1 to $55,000 between February of 2011 and November of 2021. And for them, that's good enough. But just remember what happened when the .com bubble burst. People lost a lot of money. If you like this video, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. I post about twice a week. Also, check out this video on Bitcoin and cryptocurrency, which discusses should you invest in cryptocurrency in your retirement portfolio. This is Jeff Schmidt. Thanks for watching.